The pulse of the U.S. economy can be gauged by analyzing key economic indicators. Inflation rates provide insight into the purchasing power of currency and the cost of living, with the Consumer Price Index, CPI, often serving as a primary measure. Gross domestic product, GDP, growth reflects the total value of goods and services, indicating overall economic performance. Consumer confidence indexes, like the one from the Conference Board, measure the degree of optimism consumers express through savings and spending patterns, which is directly linked to economic activity. Lastly, employment figures, such as the monthly non-farm payrolls and the unemployment rate, highlight the labor market's condition, influencing monetary policy and consumer spending. The Federal Reserve, or the Fed, plays a critical role in shaping the U.S. economy through its control over monetary policy. Interest rate decisions directly impact the cost of borrowing for consumers and businesses, affecting spending, saving, and investment. The federal funds rate is a key interest rate that influences other rates throughout the economy. Quantitative easing, another tool, involves the Fed purchasing government securities to inject liquidity into the economy, aiming to encourage lending and spending. Monitoring the Fed's policy announcements can provide investors and economists with insights into future economic conditions. Each sector of the U.S. economy faces unique dynamics. The technology sector is often at the forefront of innovation, driving growth but also facing regulatory scrutiny and competition. The healthcare sector must navigate complex regulations, demographic shifts, and technological advancements. The energy sector's performance is linked to geopolitical events, environmental policies, and technological advances in renewable resources. The finance sector is impacted by changing interest rates, consumer behavior, and regulatory changes. Sector-specific developments are important to monitor for investors and businesses within those industries. Investing in a fluctuating market requires a blend of strategy and adaptability. Identifying market sectors that are currently strong or have growth potential is key. Diversification across asset classes, industries, and geographical regions is a time-tested strategy to mitigate risk. Moreover, long-term investing typically smooths out the volatility of the market, whereas short-term trading requires a more hands-on approach and an understanding of market sentiments. Following trends, staying informed, and possibly consulting financial advisors are advisable for making informed investment decisions. The U.S. economy is deeply interconnected with the global market. International trade relations, such as those with China or the European Union, significantly affect domestic industries. Events like Brexit, international sanctions, or trade agreements can lead to substantial shifts in supply chains and competitiveness. Emerging markets offer both opportunities and risks with their growth potential and volatility. Currency fluctuations also play a crucial role as they can influence export competitiveness and the value of foreign investments. Government policies have far-reaching effects on the economy. Fiscal policies that involve changes in tax rates or government spending can stimulate or cool down economic activities. Regulations enacted by government agencies can impact various sectors by altering the cost structures and competitive landscapes. New legislation on issues such as healthcare, environmental protection, or digital privacy has the power to reshape entire industries. Keeping abreast of policy changes is crucial for businesses and investors to anticipate and respond to the changing economic terrain.